Hello everyone. We are back for another dividend stock analysis video. Today we're going to be looking at FedEx. FedEx was founded in 1971 in Memphis, Tennessee, and is one of the world's largest shipping and logistics businesses, going public in 1979. The company operates in 5 segments. The first 3 are Express, Ground, and Freight. Those are their 3 shipping segments, what you're probably the most familiar with. The other 2 are Services, and one called Corporate, Other, and Eliminations. And these 2 segments offer things like sales, marketing, and back-end support for companies. The company first started paying a dividend in 2002 and has been growing it quite rapidly recently, and it's currently yielding 1.9%. Next, we're going to dive deeper into the dividend history. But first, if you can like this video and subscribe to the channel, it would really help us out. So looking at the dividend history, one thing that stands out is the 53% increase they just did this June. It's a strong sign from a new management team that they're really committed to returning more capital to shareholders. Another thing that I'd like to highlight here is that they have an uninterrupted dividend streak of 20 years, though their dividend growth streak is only 2 years. And so you'll notice that in 2020, they didn't cut their dividend, but that's the first time that they didn't raise it. So you see that little flat line on the screen here. And then they've sort of made up for that, though, with a huge raise here in June for 53%, giving them a 15% 5-year average and over a 20% average over the last 20 years. So they're growing it really, really quickly. I think this is interesting because there's a lot of lists out there. Like if you think about dividend aristocrats, those are companies that have raised their dividend every year for 25 years or more. And they're dividend contenders and dividend champions that are different lists that have these criteria. SCHD, a favorite dividend ETF, requires that companies are raising their dividend every year. And so FedEx might be an interesting opportunity in that it's not going to fall on any of those lists just yet because of 2020, but a few years down the road, it'll start falling on those 5, 10, and so forth consecutive dividend streaks. It's very likely they're going to keep doing that. And they've got a great CAGR. There was just 1 year they didn't raise it, but they haven't cut it. And so I think that's a really interesting wrinkle. So you're not subject to being in a lot of these ETFs just yet. So down the line, you might get a boost. If it looks like a compelling buy today, that might be a nice, interesting advantage. The first thing we're going to do is take a look at our quality score sheet. The first thing we look at is value line safety. This is how safe is the stock compared to the rest of the investable stock universe in the United States. They get a rating of 2. That's the second highest rating, which is good for 4 out of 5 points in our system. Next is value line finance. This rates the strength of the balance sheet and the financials of the company, taking into account things like debt and cash on hand. This is A++, which is the highest score and is good for 5 out of 5 points. Now we're going to look at the Simply Safe dividend score, for which they get a 64. And 64 out of 100 might not seem great, but 64 is actually in the threshold, which is considered safe, which is the second highest tier, and is good for 4 out of 5 points. So 81 to 100 is very safe. 61 to 80 is safe. And so that's the range that this falls in. So we give it 4 points. Next, let's pivot to Morningstar and look at their moat. They're given a narrow moat. This feels a little bit harsh to me. They give UPS a wide moat, and I don't think UPS is that far ahead of FedEx. That said, we still give 4 out of 5 points for a narrow moat. So they're scoring quite nicely there. And lastly, we'll look at our chowder-ish number. The chowder-ish number is the forward dividend yield, plus the 5-year dividend CAGR, plus their recent buyback yield, but we cap that at 3%. And here we get a score of right around 24, which is more than 20, which is our threshold for getting 5 out of 5 points. This gives us a total quality score for FedEx of 22 out of 25, which is very, very wonderful. Next, let's dive into those Simply Safe dividend score metrics because I think there's some interesting stuff in there. They've got a very low payout ratio. So their forward payout ratio is 20%, which is exceptionally low, suggesting they very well can continue to raise their dividend at a healthy rate going forward. The debt looks pretty balanced, and we get some insights into what the company did during the financial crisis. So stock return was very low. The sales dropped, but they did maintain their dividend. So I really like when companies have been paying a dividend for a long time. It's nice if they grow it every single year, no matter what. But I view it as a bit of a red flag if I've seen them cut it before. And so just seeing them have not cut it during the 2008 financial crisis is a really good sign, in my opinion. Next, let's move on to our value scores. First up, we've got dividend yield theory. This suggests FedEx currently has a 61% upside, which is good for 5 out of 5 points. But this is sort of skewed from that recent 53% bump. So dividend yield theory compares the current yield against the 5-year average. And of course, after a 53% hike, you're going to generate a lot of upside. Typically, you would look at price action to move this. So it's good for 5 out of 5 points, but there is a little bit of a flag there to keep an eye on that one. Next, we're going to look at Morningstar's rating. They give it 3 stars, and that's good for 2 out of 5 points in our system, suggesting that it's somewhere, a little bit under to a little bit overvalued. It's in that fair value-ish range, and we like to buy stocks when they're cheap. The Finbox. So Finbox is a financial software that runs a variety of different valuation metrics and then averages them to come up with a fair value for a company. I like it because it gives you a broad look at different things like price to book, different types of discounted cash flows, dividend discount models, etc. This suggests that the fair value is $232.57 at the time of recording. I discount that to 85% of the value to add a margin of safety, which gives us a negative upside for FedEx, which is unfortunate, and that's good for no points. And then analyst fair value estimates. Analysts peg it at 288.04. I also discount that to 85% to add a margin of safety because I don't fully trust analysts, and that gives us just about no upside. So that's also good for 0 out of 5 points. So what we're seeing here is the yield theory makes it look really well priced. Morningstar makes it look okay. But the further we dig into different scores, the more we're seeing a pretty scattered picture of the value here. And we did have that one sort of pseudo red flag on that yield theory. So I'm not feeling super great about this price, and 7 out of 20 points is not super wonderful. So let's dive into our recap. So we got 22 out of 25 for quality, which makes for a very, very wonderful company. That is a great score. But then we get 7 out of 20 on the price, and that leaves us thinking that it's a wonderful company, but it's a pretty dubious price right now. That gives us 29 out of 45 total points. That's not super great. It is not in my buy zone right now. It's certainly on my watch list. The biggest point losses here are the value estimates. I think this has been propped up a bit by the huge hike, and then also because there have been some activist investors and a changeover in management in FedEx. It seems like the market's pretty bullish on that management's ability to deliver. To me, that feels like their delivering is priced in already because it looks pretty sketchily priced. But improvements from new management and activist investors could continue to improve shareholder yield at a pretty crazy rate. I'm not willing to bet on it at this time. I want the price to come back down a little bit. But if you're very, very confident that they're going to continue to hike the dividend in a really substantial way or start buying back a lot more shares, or that they've got a really great plan for ramping up the growth of the company, then maybe it could be a buy for you. But for me, I'm going to stay on the sidelines on this one. It just feels too risky at the ability to deliver a really great return. So yeah, this will stay on my watch list. But for me, this is a not buy. If you're already holding it, I think I would hold on to it. I don't think I would sell. It's a very wonderful company. I prefer to never sell. I tend to look at companies again if their yield goes under 2%, which FedEx is just under 2%. But I think their rate of growth over the long haul and the signals we're getting from new management would keep me interested. They're not doing poorly. The yield isn't under 2% because they're doing poorly. They're doing quite well. So I'd say if you've already owned it, I would probably hold on to it. Obviously, your own financial circumstances may dictate differently, but broadly speaking, I think you'd hold on to it if you already own it. But if you don't own it yet, I would stay on the sidelines. Thanks again for watching. We'll be back soon with more dividend stock analysis videos. And if there's a particular company you'd like to see me review, please leave it in the comments below. Have a good one.